this video is for those of you out there who have come across portfolio deals. You have a mix of maybe single family homes, commercial units, which is anything 5 units and up, commercial residential at least. And you're trying to figure out, how do I value this thing? How do I bring an offer in on these things? Do I go by each specific unit and value them each individually? Do I value them together? So here's some insight into what I have. Just to give you guys some background on me, I am a teller at a bank. So I have some contacts with our commercial lenders, mortgage lenders, and then I also have a couple friends in real estate as well as myself who are investors. They own hundreds of doors, right? So I was able to get wisdom from each part of the game. So here's how it goes. When it comes to commercial real estate, you have a couple different ways you can value. If the building is empty, you can go based off structural value, right? I got that tip from a land developer. You go based off structural value. If it is income producing and it has some sort of occupancy to it, you go off the income approach. That's how commercial real estate is generally valued. Residential, as you guys know, or maybe don't know, it's different. You go based off comps, compare apples to apples of properties in the area. So if you have a 3-bed, 2-bath, 1,800 square feet, maybe it's 2-story, you're gonna find other properties in the area that have sold within the last 3, 6, or 12 months. You usually go further out for slower areas to see what those comps are, and then you adjust accordingly for market correction. Now, I'll give you guys a real world example so you can better understand of where I'm coming from and how this process actually works. So I was working on a 10-unit deal, right? And I'll get right to it. Effective gross income for the year was $92,400. And then there's a 5% vacancy with 50% operating expenses. The NOI was right at about $43,890. At a 795 cap area, that puts the valuation at about $552,000, which is going to be your NOI divided by your cap to get your valuation. Right? So if we're looking at an income approach, these properties are severely, in this market, they were severely under rented. So the income approach would be about $552,000, right? Now let's move on to structural value also, and then comps. So if we were to run these residentially. On the comp side, ARV for all the properties was about $950,000. So just took average price per square foot in the area, and now I have my 2 figures valuation for income approach, and then I have my valuation for my ARV. Obviously, that's not the price that they're at right now, but possibly to what they get to. So how the lender looks at it, I'll give you guys a lender view and then also the investor view. The lender view looks at it as, we're going to value this as commercial, so off of its income approach. But a lender, for the most part, is also going to look at, if we had to take down these properties, if we had to foreclose on them and turn around and sell them, we're not going to do it based off the income approach. We're going to do it based off comps in the area approach, right? So your highest offer obviously is not going to be $950, but let's just say it's $950 for the sake of the video. $950, $550, right? And then you find a middle ground for your buyer. For me, I say buyer because I'm a wholesaler, right? But if I was an investor, I would find somewhere in the middle ground to where if I could get these rents up, this is now what it would be worth. This is what I could refi on. So here, we take it to the next step. Since it was a heavy value, since it would have been a heavy value add deal, pro forma was $1,315 rent per unit, which brought the valuation at a 795 cap, almost up to about $950,000. If cap rates compressed a little bit, that would be $979,000. And then if they compressed even more, it would be about $1 million, that's the valuation that a bank would refi on. So say you pulled out at 75% LTV refi once you got everything stabilized. That would put you, if you refied at a 725 cap, once the property was stabilized, that's $1 million valuation. That's this one right here. If you pulled out at 75% LTV, that would be about $775,000. So as an investor, now we're going to go into the investor lens. How I'm going to look at the deal is most likely income approach as well. Say we're looking, say you have an investor looking for the income approach, and they're not looking to flip around and turn these buildings, these residential buildings, fix them up and flip them. Maybe you can make more of a profit that way. So you have to think about what your exit strategy would be, and then line that up with how you're going to offer this price. So for me, I'm just going to give you guys insight on how I would do it personally. I would take the income approach because it's also across the street from a student housing facility. So you would make more money in the long run, more long-term rents, just renting it out rather than selling the home. So I would take it, get the rents up to 13, 15, get the valuation up to $1 million, right? By forcing equity with rents and hopefully cap rates compressing over time. Refi 75%, pull out $775,000 cash, move on to the next deal, right? So my offer wouldn't be as low as 550. It would probably be around the 715, 730 mark, especially if there's deferred maintenance or capex expenses. You have to take all those things into account. That's how I would think about it. Make an offer at around maybe low 700s, 715, 720, depending on how much work the property needed, and then work to get those market rents out, refi, pull my cash out, still hold the property, and then move on to the next deal. So that's how you value a portfolio deal. One, it depends on what your exit strategy is. You also want to be considerate of the seller, what their cost basis is, what their needs are. And then just to be safe, you want to look at it from a lender's point of view if you are getting bank debt, because you have to think about and consult with them obviously as well, because this is just how my bank would operate. Consult with them on how they would value the property, but that's pretty much standard operating procedure. So hope this video helped. Leave a comment if you guys have any questions. I'd be glad to help. Peace.